Welcome back to the channel. If you copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're gonna speak today about a stock called LEN, ticker LEN. And essentially, these guys are home builders. So they build houses for people to live in. And it is a rather capital intensive industry where you need to buy a plot of land and build homes. These guys, on the contrary, do have a slightly different model, which is more capital light and more asset light. However, as you can see in the chart here, the stock has been struggling for quite a while. So it's been quite a bit down since the end of 2024. And it also has had a bit of a pullback recently. But I do think that the long-term trend is going to continue or perhaps resume in the next few days, perhaps the next couple of weeks. And why is that? Let's take a step back and look at the macro side. So the American home ownership at the moment is in a challenging position. Mortgage rates are stuck near 7%, and the median home requires people, the household, to earn at the very least 157 $150,000 in income. So with that and the current economic situation, only 17% of Americans believe it's a good time to buy. Now the Fed has promised to rate cuts, and the market is expecting that they will in September. As a matter of fact, the report suggests that the market is positioning itself for a 90% probability. And that's one of the tenets of this trade. It's a bit of a contrarian trade. Because what if the Fed, for whatever reason, even though the macro picture is deteriorating, decides that interest rates are here to stay for a little bit longer? That would certainly be a big shock to markets, and it would mean a strong rotation of positions by traders. So that is certainly something at risk that I see the market is under pressing at the moment, and something I want to get protection against my long book. Now, coming back to the macro picture, the affordability crisis is creating a bit of a death spiral. Builders cannot sell homes without massive incentives, but those incentives destroy their profits. And in spring this year, we already saw how the market was disappointing, and the next season ahead of us is historically been quite weak. So with that, if we look at, for example, the value chain, we can see that buyers are priced out. So millennials account for about 29% of home ownership versus 38% compared to 2023. First-time buyer age is actually rising to 38 years old, and 82% say that market conditions are terrible. Builders, on the other side, are forced to offer 4 to 6% incentives industry-wide, but this is causing their margins to compress to decade lows. And builder sentiment is at 33, which is the third lowest since 2012, back when the effects of the credit crunch were still pretty noticeable by the consumer. Suppliers at the same time are passing on the pain to the builders because lumber is up 16% year on year, and Canadian tariffs have doubled to 35%. So that has led to construction costs rising almost 10% annually. And last but not least, the land developers are stuck with inventory. So we have 9.8 months of new home supply, builders accumulating spec inventory, and land prices under pressure. In the middle of all this, LEN put the strategy to pursue volume at any cost. Their competitors like D.R. Horton and Pult Group maintained their margins. They took actions in order to do so. However, with LEN, they have seen their gross margins fall from 24% to 18%, and is expected to continue falling further. Their incentives are 13%, about double the industry average, which you could argue might not be sustainable down the line and might cause certain announcements from management, um, because that might not be something that they can sustain in their business model. This has resulted in their cash flow turning negative in Q2. And if we look at, for example, what has happened recently, you can see that since July, the stock started picking up. So it fell, found a bit of a floor for a brief period of time, about 100, and now we are all the way back just over 130. And this to me as well signals another potential opportunity why this could be a short. So I mentioned earlier about the market pricing or being overly optimistic about rate cuts and so on. But what I didn't mention is that the company has tried to differentiate itself by building AI systems, ERP transitions, and introduce revolutionary sales tools, which have caused SG&A to balloon to 8.2%, which is rather significant for a company this size. So all those things have not translated into material growth yet, and we don't know when they will. But at the same time, uh, we will see in their next earnings report the margins, which could break below the 18%. We could see as well guidance being cut. And along this line here, I genuinely feel that this could have been propped by the introduction of this AI component into the narrative that has caused the stock to recover a little bit. But what if those things, that if that narrative is destroyed in the next earnings call because it's not driving any meaningful results? The market could simply lose patience with this narrative. So all those things accumulate in a sharp drop. Another point as well was the recent news yesterday that Berkshire Hathaway bought an 800 million stake in this company. And you can see here that the stock jumped quite a bit. So we can see that this has caused significant rise in the stock. It's above the 250 SMA level, which is big resistance. And I foresee there's going to be some more momentum going over the next few days. But at that point, there will not be any kind of headroom for the stock to keep going. And this is why I'm looking at the stock thinking, well, look at the target, the price target versus actual price difference is at the lowest level that it's been in a long, long time. As a matter of fact, if we look at the historical 10-year, it has never been above the average price target as much as it is now. So I just kind of see how this stock can keep going much higher after the momentum from the trade, the Warren Buffett stake has been announced. And when that time comes, it is likely that I will be actioning a short position. Because at the moment, what we have here is a lot of headlines, a bit of a narrative for AI, but the fundamentals of both this sector and the company have not changed, at least on paper. That may be proven wrong in the next earnings call, and that's the biggest risk of this trade. But we could see the stock, if those negative catalysts materialize, go all the way back to 100. And that's the way I'm going to position this. So I'm going to probably let it rise a little bit more, perhaps to $140, and then buy some puts of around 130 strike, write that over earnings, and can easily generate a 3x return. Hope you enjoyed the video. See you soon.